IV crush. So what is IV crush? IV crush is a phenomenon where we see implied volatility get crushed out of the market. Right now on the screen, I have Netflix and I'm showing the daily chart. And in the lower section is a cyan line showing the implied volatility. Now, technically, this isn't looking at the options on Netflix, but most analysts, when they're talking about implied volatility, they'll show you a daily chart with the stock in the upper portion and the IV indicator in the lower portion, and they'll talk about the implied volatility. So we can start with this just because we can actually see the visual, we can see the crush. But the IV crush really happens in the options chain, not out here where we're looking at a stock chart. It's really easy to confuse volatility with options volatility. But this crush mostly happens during an earnings event, but it can happen during other binary events, say biopharmaceuticals when they come out with a new drug or drug trial, companies that had a lawsuit that maybe gets dismissed or gets resolved. So if there's some sort of event, some cause for volatility to rise, and then that event gets resolved, we'll often see this same behavior. Now, I chose Netflix because it also had this nice trend down in volatility. And it took almost a year and a half to go from the peak down to the trough. And that is not a volatility crush. That is just a gradual reduction in volatility over time. A vol crush is when we have a binary event that has elevated the volatility, and then news comes out, the unknown becomes known, and volatility gets crushed out of the options. So here we can see between this earnings and this earnings that we had the volatility crush, and it kind of fell a little bit more over the next month or so. And then it began creeping back up as we got closer and closer to the next earnings. And then we crushed again. And the same thing. And then we crushed again. So this crush is the IV crush that we're often referring to. So let's go and look at a real options chain rather than just looking at the chart, and discuss where we can see this IV rising up, and then discuss how we can measure that rise and even kind of measure what kind of crush we're going to see. So as we get closer to an earnings, the implied volatility, the average implied volatility, which is right here on the right side of the chart, that will begin to rise rapidly. And the way that we spot this volatility is it will often be 4 or 5 times greater than the volatility of the other names around it, or the other time frames around it. So we call these things series. This is the front series or the front week. And the way that we want to measure a potential crush in IV is we want to take that front week's implied volatility, and then we want to go out to the next monthly expiration. So if Netflix had earnings this week, we would take this week's implied volatility average, and then we would go out to the next month, which would be December, to that month's monthly options expiration, OPEX. And that would be the December 15 implied volatility. So we would take this one and subtract it from this one. Okay, so that would give us our crush just for the potential crush of that trade or of that earnings event. For our trade, if we wanted to know how that crush would affect our trade, we would then build our position and subtract and multiply that crush Most times, people really don't try to um, define their position's risk or their position's potential impact to IV crush. But if you wanted to, that's how you would do it. The main thing is just understanding what IV crush is, how to recognize that there is the potential for a crush, and when that crush is supposed to happen. So since I mentioned that there is nearly always an event to it, whether it's earnings or one of the other events that I mentioned, we've nearly always got a date to that. So we can pinpoint in time when this is supposed to happen. There's also history. So here on the stock chart, for an example, we can see how has Netflix performed in the past, because not all companies have such a clean and beautiful ramp into earnings. And they also don't have such an exaggerated crush after earnings. Some companies just have really boring earnings. So, for an example, let's just kind of hunt around a little bit. Here's Caterpillar. And with Caterpillar, for an example, we don't have this continuous crush and ramp that we were seeing. In fact, it's more sloppy. We can see how it's kind of all over the place, dropping all on its own, rising for other reasons, big gaps up in the market, crushes that really didn't go very far. So here was an earnings where it had almost no crush at all, right? Understanding how your particular market history is will really help you gauge the kind of volatility crush you could see on the particular thing that you want to trade. So if you're thinking about an earnings trade, or you're considering a position that you already have and we're getting closer to earnings and you're worried about the impact of earnings on your position, you would want to gauge the history that that particular company has for its IV crush. We just had earnings in NVIDIA, and so we can use this for an example. It didn't normally have a horrible IV crush, right? We can go look in the past here where it just really wasn't so bad. And it wasn't very clean either compared to the one on Netflix. This year in 2023, things have radically changed for NVIDIA. We seen its stock price go up 200% in the last 12 months. And at the last earnings, not this one, but the last one, there was a very exaggerated ramp up into earnings and a phenomenal crash of the IV after earnings. And as you notice here, we stayed down at that level for a long time. And then we had one more dip before we started to rise back up to the next earnings. But notice how we didn't rise even half as much as the last time. That's a phenomenon that we often see when a company surprises on earnings when they normally don't have a surprise. That gets everybody's attention. And what they do is they start focusing on the possibility of another surprise at the next earnings. So what I mean by that is, if we back up a little bit, rather than looking at the earnings where we had the big dump, look at the earnings before that. We had, minor earnings and minor earnings when we think about IV and the crush, but this is what got investors and traders' attention. There was a significant offside trade here, right? It's a big imbalance. So, traders see that, and we get closer to the next earnings, and they begin to think, gee, what if we get another one of those really big earnings misses and big earnings surprise? That, of course, that unknown really begins to accelerate the IV, and we get this massive ramp. Then on this earnings, we really didn't see the kind of follow through, the kind of miss that we had saw before, and there was a significant dump. And then the next time, since it wasn't a repeat performance, we didn't see such an elevated ramp into this earnings. But you can find that kind of history in things like Netflix or even Meta. Meta has had some fantastic earnings misses over the years. And you'll see where there'll be kind of a complacent market. Everybody just kind of believes that it's getting boring and there's no real big moves in it. And then they'll surprise and catch people off sides, and there'll be a fantastic move in the market. And after that, you'll see the implied volatility values really ramp up. But after more and more misses where there's just no real excitement, each ramp up tends to be less and less and less until finally we start to bottom out like we did here with Netflix. Notice that real big gap here and the real big gap before that one, and how the IV after every one of those just kept going higher and higher. Those misses gets everybody's attention. And so they think, well, on the next earnings, I'm going to be ready for that one, right? And then we finally get an earnings where there's no big move at all, no big miss at all. And what happens after that? Well, then we start going in the other direction, declining back down again. So implied volatility crush is when massive amounts of IV, of implied volatility, get crushed out of the options in a very short period of time. Usually in a single day, we see the most volatility taking out. And then over the period of the next week or so, we see the rest of it kind of slowly fade away again. So here, for an example, we had earnings, so the big crush, but then over a period of the next week or two, it continued to bleed out more of that volatility until finally it was done. Same thing here, big crush at earnings, and then it bled out a little bit more over the next 2 weeks, and then finally it was done. So that's kind of the idea behind implied volatility crush. It is related to events because to have the crush, you need the ramp, right? It needs to have that false rise in volatility. And we call it a false rise because in reality, what's going on here, volatility is measured by movement, right? Typically, normally. So when we try to measure volatility, we use candle close to candle close here on the chart, not within the options IV. When you think about this rising volatility and you look at these candles, the distance between candle close to candle close really isn't accelerating or widening out. And yet the IV continues to go higher and higher and larger. When in reality, what's happening here, the reason that this volatility is rising up isn't because the distance between candle closes is getting wider. It's because there's more and more unknown as we get closer to the earnings event or another binary event, because it, as I mentioned earlier, could be a court case, a court battle. It could be a new product release, drug trials ending. Any event that has a date and time to it can become a potential volatility crush opportunity. This is not the same thing as just seeing your options lose value from a market rising, right? When stock prices rise, volatility within the options tends to fall. That's not the same thing as a volatility crush. And while there are examples of intraday trading where we see, quote, vol crush, when the market makers come in and perform maneuvers, that is generally not associated with the term volatility crush in this sort of relationship. So it's easy to get those sort of things confused. And it's mostly due to the fact that the more modern trader using intraday tools that are like black box stocks and cheddar flow and unusual options activity for intraday trading, trading ticks and spot gamma, those kind of tools that are focused on intraday volatility crushes is a completely different sort of trade logic than this trade logic. The old school classic volatility crush is exactly what we've been talking about here today. Earnings events or binary events that cause a unknown in the market with a ramped volatility, which then gets crushed out of the market's options on that day's release, that day's data release. So that is IV crush, and that is how to find IV crush, how to recognize the history of IV crush, and even potentially how to plan and prepare for IV crush.